Hello everyone, welcome back to our Accounting 210. In this video, we continue with the chapter 10, Performance Evaluation. Last time we talked about the master budget variance, and then I mentioned that um, giving this one overall number cannot give you the details. So we want to break down this one number to two parts, right? Like your exam, you want to break it overall to multiple choice and then problem. Similarly, for the business, they want to know, hey, look at how do you get the revenue? Hey, answer, look at this number, right? How do you get the revenue? Revenue is your dollar amount. It is your units times the dollar amount, right? So the units times the dollar amount. So when you have the actual, is the units 32,370 times the dollar amount to get this your revenue. For the budget is also 30,000 times your budgeted price to get this revenue. But if we just get this revenue, we do not know the favorable results is from you sell more units or because your selling price is higher. So we want to break our master budget variance to two parts. The first one is called flexible budget. The second one is called as our volume variance. Okay, so we focus on the first one first. Flexible budget is prepared for the actual sales volume achieved. It's the budget managers would have prepared at the beginning of the period if they had a crystal ball telling them the correct volume cases. The flexible budget allows managers to compare actual revenue and expense with what they could have expected given the actual sales volume. Okay, answer the question. Hey, your English is so good. Answer the question. Do you understand what this paragraph talks about? Yes or no? When I read it, I kind of got the idea, but I didn't really get it 100%. So let's look at what it generally really want to tell us. So flexible budget that tells us that, hey, the managers, if they had a crystal ball that will tell them what the actual sales volume will be, then they can have the proper number. So what is flexible budget is made of? It's made use the actual sales volume, So as I said, for everything, it's the units, right? It's the unit time the dollar amount. So for the revenue, it's the actual sales units times the actual sales price. For the variable cost, it's the actual amount times the actual each unit the price, right? So for your overall dollar amount, it's the units times the dollar for each unit. So for flexible budget, is you use the actual sales volume. You use the actual sales volume, but you use your actual the price and compare with your budgeted price. So we hold these units constant using the actual number. We compare the dollar amount from the actual dollar amount with the budgeted dollar amount. Let's look at this example. Now we focus on flexible budget. We call it a flexible budget. It's still a budget, but it's a flexible budget because we use the actual sales volume. Okay, we still put the actual on the left side. Now we have this budget. It's not a master budget, but it's the flexible budget. It's the flexible budget. And the difference is called flexible budget variance. The difference is called flexible budget variance. And what you will know is when we talk about flexible budget variance or flexible budget, we always use the actual sales volume. So you use the actual sales volume. Our actual sales volume is 32,370 units. Our budget, flexible budget, we use the same number, 32,370. Now, We want to get our sales revenue, right? We want to get our sales revenue. You know the actual is 653,874. You said, how do you know? The question already told you. So we just basically copy the actual to this actual. We copy the actual to this actual. And for our flexible budget, it uses, we use the what? For our flexible budget, we use our actual amount. We time the budgeted dollar price. So for our flexible budget, how do we get our flexible budget? 647,400 is we use the actual amount, 32,370. We time our budget is what? Our budget is $20 for each one, right? So if you do the math, I do the math with you. So let's do the math. Okay, so we use our actual output, 32,370. We time the budgeted selling price, $20 each. We get our flexible budget revenue is 647,400. Your actual is 653,874. Your budget is 647,400. So do you have a favorable or unfavorable? Your actual is better than the budget. So we have the favorable result there, right? I'm not going to do the numbers. The amount will be the difference of your actual and your budget. You can get this from your textbook. So this is how you do our flexible budget, is you use your actual unit time the budgeted dollar amount. So similarly, for the cost of goods sold, you use your actual output, it's 32,370 time your $12, you will get your flexible budget of the cost of goods sold. You get sales commission, shipping expense, bad debt expense. So flexible budget is you use the actual units time your budgeted dollar amount. And then you can find out, hey, for this scenario, your actual operating income is lower than the flexible budget operating income. So you have an unfavorable operating income variance. The flexible budget shows what the revenue and expense should have been given the actual output. It's created using the original budget assumption for variable cost per unit, right? So you use the budgeted per unit, but using the actual sales volume, So you will get the variance. So why we have this? Why it's important to do this? Because you control the unit. So you use the actual unit for the actual, you use the actual for the flexible. If there is any difference, if there is any variance, it's not because of the units, but because of the dollar amount, Let's double check using the revenue as example. So our actual revenue is 653,874. We generated this much revenue based on 32,370 units. So our each one, the actual selling price is, did you see that number? The selling price is how much? It's actually $20.2. It's $20.2. So we have this favorable sales revenue, not because we sold more units, because we sold the same units, but because our selling price is higher than our budgeted $20 each. We budgeted to sell at $20 each, but actually we sold at $20.2 each. So for each unit, we get 20 cents more. right? We get 20 cents more. That's why we have a favorable revenue. So if you have any variance in the flexible budget variance, it's not because of more or less units. It's because your dollar amount of your actual is more or less than the budgeted dollar amount. Do you get this? We will practice one. So you hang on there, and then I will tell you more when we have the practice. But your textbook also said all the variance related with your volume. So it's already given. We talk about this. We said the variance in the revenue. So if you do the number, you should be able to get the variance should be 6,474, right? So you have the favorable revenue for the sales revenue, not because you sold more or less units, but because your selling price, the dollar amount, your actual is 20.2 each, is more than the budgeted $20 for each unit. So we control for the units. If there is any variance, it's because of the dollar amount between your actual and between your budget. Okay, so similarly for all the variable cost, and then if this is the case, you can find out that some of these fixed expense, they have zero variance because no matter what your units are, your fixed costs, sometimes they are fixed. So if you have your actual and then your flexible budget, that will be zero favorable variance. But I do not worry too much about the fixed cost. All I want you to know is get the concept of what is a flexible budget. Okay, so first thing is what is the flexible budget? Flexible budget is you do the budget using the actual units. And then second is what is a flexible budget variance? What's the flexible budget variance? Flexible budget variance is the difference of your actual minus your flexible budget. And then if there is any variance, it's not because of the units, but because of the dollar amount for each unit. Okay, I stop here. I believe some of you are confused at what the professor is talking about. As I said, we will do some practice, and hopefully you will feel better after I summarize this flexible budget and then the volume variance. Okay, I see you next time, and then in the next video, we will cover for the volume variance, which is opposite with the flexible budget. I see you there. Bye.